Assalamu alaikum students. This is your teacher Aska, and I teach business and accounting to an A-level students. Uh, so in this particular video, we are going to complete Olevels, IGCSE, GCSE, Accounting Paper 2, Variant 3, October, November 2024. So we are going to solve the question from the end. Okay. So as you can see that in this particular question, what we have to do, first of all, read the question first. Okay. So we have to prepare the manufacturing account for the year ended 31st March 2024. Okay, first of all, what is the format for the cost of manufacturing account? First of all, we need to write the cost of materials consumed. Cost of material consumed. Okay. And after that, we have to write the opening inventory of material, opening inventory of raw material, and purchases of raw material, and less closing inventory of raw material. Closing inventory of raw material. Okay, so whatever the answer you will get, you will write here. Okay. And after that, you have to add the direct wages in the total of cost of raw material consumed. You have to add the direct wages, royalties, if you have. Okay. So whatever the direct wages, you write it here. Royalties, you will write it in the first column. And altogether, total of the raw material consumed plus the total of direct wages and royalties will known as a prime cost. Okay. And after that, you have to write the factory overheads. And in factory overheads, first of all, you need to write the wages of factory supervisors. Second thing is factory general expenses. And factory rates and insurance. Okay. And depreciation of factory machinery. And you have to add opening work in process less uh, work in closing work in process. Okay. Um, and at the end, you will get the answer of your cost of production. Okay. And in the next question, they are asking us to write to maintain the trading section of income statement. So what does it mean? It simply means that we have to prepare the trading section only. It means that from revenue to gross profit. First of all, you will write revenue. Okay. In the this column. After that, deduct cost of sales. And The cost of sales. In the cost of sale, you are going to write the opening inventory of finished goods. Okay. And you also need to add the cost of production, which you just find out from here in the manufacturing account. Okay. And also you have to write the purchase of finished goods. And if you have any carriage inwards, so you also need to write it carriage inwards. Carriage inward on finished goods. And you need to deduct the closing inventory of the finished goods. And after that, you will be having your gross profit. So we just made the whole format. Now it's very easy for us to calculate. First of all, we have to find out the opening inventory for raw material. Okay. So as you can see that the opening inventory for the raw material, you have to prepare this manufacturing account for 31st March, year ended 31st March 2024. So what will be the year start? So year start, of course, this is 1 April 2023. So as you can see that there's an inventory for the raw material, which is 18,200. So we have to write 18,200 here. Okay. And let's see this next thing. Purchases of raw material. Okay. So let's see the purchases of raw material. Okay. So we have the purchases of finished goods and raw material. So raw material purchases are $68,000. Next thing is the closing inventory of raw material. So this is the closing inventory because this is the year end inventory. So closing inventory is 19,280. So if you just add the opening material and purchase of material and deduct the closing inventory of material, so you will get the answer. And this is 66,920. Okay. Uh, Now let's see the direct wages. Okay, so as you can see that in the direct wages, we have the wages for the factory operatives, which is 1,83,000. Let's see. $183,700. Royalties, 3,240. Now add direct wages and royalties with the total cost of the raw material consumed. So this is known as the prime cost. Prime cost is 253,860. Okay. Um, okay. Now let's see the factory overheads. So in the factory overheads, first of all, we have the wages of factory supervisors. So this is factory supervisor, which is 47,200. Factory general expenses, which is 20,250. Factory rates and insurance. So factory rates and insurance is 7,100. And if you see that there is an adjustment for the rates and insurance. So they are saying that rates and insurance are to be apportioned 60% to the factory and 40% to the office. So now what does it mean? We will be first of all applying the 60% on 7,000. So you'll get the answer, which is 620. So you will write 700 plus 620, and you will be writing the total of this. So 7,100 plus 620, 60%. And this is equal to 4628. Sorry, 4632. Now let's see the depreciation. So if you see the first additional information, that factory machinery is to be depreciated at 15% per annum using the RBM. Okay. So it means that for RBM, we have to apply this 15% on the net book value. Okay, so as you can see that we have the factory machinery at cost, which is 2,47,000. And we also have the provision for this machinery, which is 51,500. So first of all, we need to deduct the provision for depreciation from the cost, and we will get the net book value. And after getting the net book value, we will apply the 15% on the net book value, and we will get the depreciation for this year. Okay, so the cost is 247,000. Okay, and we have to deduct the provision, which is 51,500. And whatever the net book value you will get, just apply 15% on that. So you're getting the answer, which is 29,325. Okay, so if you just add the prime cost and all the factory overhead expenses, so you will get the answer, which is 355,267. Okay, now add opening work in process in this. So what is the opening work in process? So opening work in process is 23,400 and closing is 22,650. And deduct the closing work in process, which is 22,650. And if you just add the total of factory overheads and prime costs and add opening work in process less closing work in process, so you'll get the cost of production, which is 356,017. Okay, now let's find out the revenue for the trading section of income statement. Okay, where is revenue? Okay. So as we can see that they haven't provided the revenue, but they have provided us the markup rate, which is 35%. So we can easily get the revenue by using the 35% of markup. So if you want to find out the revenue. So first of all, you have to find out the cost of goods sold. So as you can see that I have written the opening inventory of finished good, cost of production, purchase of finished good, carriage inwards on finished good, and I deducted the closing inventory of finished goods. So I got the cost of sale, which is 3,88,080. Okay, so by using this, we can easily find out the figure for the revenue. So revenue is basically equal to cost of goods sold multiply the markup 1 plus markup rate. So cost of goods sold is 38808, okay, 0, and multiply, and markup is 35. So just convert this into decimal places. This is 1 plus 0.35. So this is 38808 multiply 1.35. You'll get the answer, which is 523,908. So this is revenue. Okay. So now let's deduct the cost of sale from the revenue. So you'll get the answer for the gross profit. So the gross profit is equal to this is equal to gross profit is equal to 1,35828. This is the gross profit. Okay. Now let's see the other question. G Limited make all sales on carrot and have supplied the following information. At 31st March 2024, we had a trade receivable turnover, which is 38 days, and irrecoverable debts was 32,060. At 1st April 2023, the trade receivables are 29, trade receivable turnover days in 29, and irrecoverable debts are 19,200. Directors of G Limited are worried about the level of debts from credit customers and are considering employing a consultant to review their credit control policy and implement any changes. So they would provide training to the existing staff in the new procedures. And the consultant would charge a fee of 14,000 for their service. So we have to advise that G Limited whether to employ the consultant to review their credit control policy. Justify your answer with 2 advantages and 2 disadvantages. Okay. So let's discuss this. We have to write the advantage, 2 advantage and 2 disadvantage, and at the end we will be doing our conclusion. Okay. So first advantage of employing the consultant is that there is improved debt collection efficiency. So a consultant specializing in credit control would bring a wealth of experience in optimizing the credit management process. So this could result in a reduction in the trade receivable turnover days, which we have seen, thereby improving cash flow. So as a company's trade receivable turnover days increase from 29 to 38, we have seen this in the case study. So there may be room for improvement in collecting outstanding debts more efficiently. So a consultant could offer targeted strategies to minimize late payments and improve the collection procedures. Second benefit we will get that there is expertise in the risk management. So basically, a consultant could analyze the current customer base and identify the risky clients and recommend adjustments to the credit policy. So this would enable G Limited to better manage the risk of irrecoverable debts, which increase from 19,200 to 32,060, which better credit risk assessment and company can reduce the likelihood of bad debts, thereby safeguarding its financial health. Now let's discuss the disadvantage of employing the consultant. So first thing is that there is consultancy cost. So consultant charges a fee of 14,000. which may be a significant expense for the G Limited. So considering the company's trade receivable turnover has already increased, so spending this amount could place additional strain on the company's finances, especially if the improvements resulting from the consultant advice do not lead to rapid enough return on investment. Second, disadvantage is potential resistance to change. So employee may be resistant to adopting the new credit control policy or procedure. So especially if they feel that their current methods are sufficient. So training required to implement these new procedures could also take time and effort, so which could disrupt the workflow and temporarily reduce the efficiency. Additionally, the consultant suggestions may not always align with the company's culture, potentially leading to challenges in the implementation. So in conclusion, we can say that while employing a consultant provide valuable expertise in improving credit control, the cost and potential resistance to change should be carefully considered. So if the company believes that consultant services will significantly improve the cash flow and reduce the bad debts, so then employing them would be beneficial investment. But however, G Limited must weigh the consultancy fees against the expected benefits and ensure that the new procedures will be accepted and implemented effectively. Okay. First of all, we have to calculate the depreciation change charge for the year ended 31st December 2023. Okay. So basically, we are going to calculate the depreciation. Okay. So as you can see that, let's read the question first. A company has a fleet of delivery vehicles. Information from their statement of financial position at 31st December 2022 shows that vehicles originally cost 4,40,000 with accumulated depreciation which is 270,000. Business purchased two additional vehicles costing a total of 70,000 on 1st April 2023 on credit from L Autos. 30 November 2023, business sold one of its vehicles. Vehicle had originally cost 28,000 with accumulated depreciation for 16,800. So vehicle was sold for 10,500 to a local garage who paid the bank transfer. Business provided the depreciation using the straight line method at a rate of 20% per annum. Full year depreciation is charged in the year of purchase. No depreciation is charged in the year of disposal. So basically, we have to find out the depreciation charge for the year end 31st December 2023. First of all, we have to write the cost of the machinery at the start of the year, which is 4,40,000. Okay, and we have to add the new cost of new vehicles, which is 70,000. Okay. Now we are going to deduct that vehicle which is we already sold. And that is 28,000. Okay. So you will get the cost of vehicle had at the year end. This is equal to 4,82,000. Now just apply the 20% SLM method on this. So you'll get the answer for the current year's depreciation. Now we are going to make the delivery account. Okay. Delivery vehicle account. Okay. First of all, we have to write the opening balance. We are going to make the account for 1st January 2024. Okay. So 2023, January 1. We have the original cost of the vehicle at 31st December. This will shift to the open 1st January 2023, which is for 40,000. Okay. And during the year, we have purchased one more additional vehicle, which is $70,000 cost. So I have to write it here. L Autos 7,000. And one of the asset we have sold out. 13 November 2023, the business sold one of its vehicle and its original cost was 28,000. So that's why we have to credit this from the vehicle account. So now what is the total of the heavy side? This is equal to 510. And now deduct the credit side of disposal, which is 28,000. So your closing balance will be 482,000. So this balance will shift here. Okay. Now we also have to prepare the provision for depreciation account. So the nature of the provision for depreciation account is always carrot whenever it is increasing, and when the depreciation will decrease, so it will debit. Okay. So it means that we have to write the opening balance on the carrot side. And the asset which we sold out, what was its depreciation? Its depreciation was 16,800. So it means that we have to decrease the provision for depreciation account by this value. This is disposal. This is equal to 16,800. Okay. And we also have to shift the current year's depreciation into the income statement. So what was the current year's depreciation? We just find it out here. Depreciation for the year is 96,400. So we will be shift it in the income statement. So income statement will be debit and provision for depreciation account will be credit. So now add. So heavier side is the credit side. This is 349,600. 349,600. And deduct 16,800 from the total. So this is equal to mm, 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 mm. Sorry, the total of the credit side is not this. This is 366,400. We also have to prepare a disposal of delivery vehicle account. Okay, so which delivery vehicle we disposed of? What was its cost? Its cost was $28,000. So it means that we have to credit the delivery vehicle account and debit the disposal account. And what was the provision for that disposed of delivery vehicle? The provision for depreciation balance was 16,800. So we have to decrease the provision for depreciation account. We have to debit our depreciation account, and we have to credit the disposal. And the amount which we got by selling that asset was 10,500. So we have to add this bank debit and disposal credit. And now, is this a disposal gain or disposal loss? How we can find it out? First of all, the cost of delivery vehicle, deduct the accumulated depreciation from there, and you will get the net book value. So after that, compare net book value with the received amount. If the received amount is more than net book value, this is gain on disposal. And if the received amount, it means the sale price it is less than the net book value, so it is gain loss on disposal. So cost is 28,000 minus provision for depreciation is 16,800, and this is equal to, let me calculate, 28,000 minus 16,800. This is equal to 11,200. Okay, 11,200 and 11,200. Okay, and the amount which you received is 10,500. So it means that there's a loss. So loss is equal to 700. So it means that this is the loss and disposal. So if there's a loss and disposal, so your income statement will be debit and disposal account will be credit. Now let's see the advice question that after talking to his accountant, the owner of the company is considering changing the method of depreciation for his delivery vehicle to the reducing balance method. but maintaining the rate of depreciation at 20% per annum. Advise the owner of the company whether he should pursue this course of action. Justify your answer by providing two advantages and two disadvantages of changing the method of depreciation to the reducing balance method. Okay. So first of all, we are going to write two advantages for this first. So advice on changing depreciation method to the reducing balance method. First, let's see the advantages. So first advantage is that there's a high depreciation in the early year because you are using the RPM. So under the reducing balance method, depreciation expense is higher in its initial years, of course. So of an assets, because at the start of the year we will apply the rate on the cost, and after that we will be applying the rate on its net book value. So with the passage of years, if you are using the RPM, so depreciation amount will reduce, but at the start of the year it will high. So this can result in lower taxable income in the early years and thereby reducing the company's tax liability. So this may be beneficial for the company if it's looking to reduce its tax burden and improve the cash flow in the short term, especially if the delivery vehicles are now and have a significant book value. Second advantage is that there's more accurate reflection of the asset usage. So the reducing balance method better matches the expenses of the asset with its usage and wear over time. So as delivery vehicles often experience higher wear and tear in the early years, so method provides a more accurate reflection of the depreciation in line with assets' actual reduction in value and productivity. So this can lead to more realistic portrayal of the vehicle's value in the company's financial statement. Now let's discuss the disadvantage of changing the RBA method. So there is a lower depreciation in the later years. The years we will be using the rate of depreciation of the net book value of the asset. So while the reducing balance method offers higher depreciation in the early years, depreciation expense decreases over time as the asset's book value reduces. So this could lead to a lower depreciation charge in the later years, resulting in higher taxable income and consequently a higher tax liability as the vehicle ages. So this may not be desirable for the company in the long run if the goal is to continue reducing taxes over the asset's useful life. Next disadvantage is that there is a complexity in calculating depreciation. So reducing balance method requires recalculating depreciation each year based on the remaining book value of the asset. So making the process more complex compared to the straight line method, where depreciation is evenly spread across the asset's useful life. So owner and the accountant would need to invest more time and effort in maintaining accurate records and ensuring the calculations are performed correctly each year, so which could increase the administrative cost. So now let's conclude the answer. So changing to reducing balance method could be beneficial in the short term by providing the higher depreciation expenses and reducing taxable income, which can improve cash flow. However, this method may result in lower depreciation charges in the later years, which could increase the tax burden. So additionally, the added complexity in calculations and potential for increased administrative costs should also be considered. So owner should carefully weigh these factors and assess whether the advantages in early years outweigh the long-term implication of the lower depreciation. Okay. Now let's see the next question. Complete the following table by placing a tick in the appropriate column to indicate the more suitable method of depreciation for each of the non-current assets. Okay. So we have the non-current assets. First of all, land, fixture and fittings, and loose tools. So on land, of course, we will not charge depreciation. For fixture and fittings, the most appropriate is straight line. And on the loose tools, we'll be using the revaluation because these are the loose tools. So that's why we will just basically forecast its depreciation in each year. Let's say if we have loose tools, we have purchased loose tools in 2021. So we will be defining and we will be estimating its depreciation. Let's say its net book value, let's say this is 28,000. And in 2022, let's say we are estimating that maybe its net book value now is, let's say 20,000. So if you just want to find out its depreciation, how much your loose tools has depreciated within 1 year. So it means that it has depreciated with $8,000. And for loose tools, you will not apply a critical type of depreciation method because, of course, at the end of the day, these are the loose tools, and loose tools are most of the time perishable. And it is not that very important that we should spend a lot of time to calculate the depreciation for the loose tool. That's why. Okay. Um, so we are going to complete the question number 3 now. Natalie prepared her trial balance at the end of the year 31st March 2024. Totals did not agree, and she had to open a suspense account. Debit side of the trial balance was 357, higher than the credit side. So Natalie later discovered the following errors. So we have these following errors: 1, 2, 3, 4, 5. Uh, so we have to prepare the journal entries. Okay. First of all, what is mm, okay. Okay. First of all, we have bank transfer of $420 received from a credit supplier, Sarah, had been correctly recorded in the bank, but no other entry been made. So it means that we have to, because she was a credit customer, so now Sarah has paid the amount. So we have to decrease the Sarah. We have to decrease the customer. That's why we will be crediting the Sarah. And on the debit side, where there is nothing, we will be writing the suspense account. So suspense will debit with 420 and Sarah will credit with $420. Okay. Now let's see second. Natalie contributed a personal vehicle to the business valued $77,000. This had been debited to the capital account and credited to the vehicle maintenance account. So it means that first of all, we have to debit the vehicle maintenance account, but because we accidentally credited. And we also have to debit the motor vehicle account since it is coming into the business. And we also have to credit the capital account since this is the capital investment by the owner. Okay. Now let's see the third one. Purchases of $270 had been correctly entered in the supplier's account, but had been debited as 207 in the purchase account. So if you just find out the difference of 270 and 207, so this will 63. So it means that we have to debit the purchase account with 63, and where there is nothing on the credit side, we will write suspense. Okay. Uh, Fourth one is that no entry had been made for general expenses 126 paid by the bank transfer. So again, we have to make the entry. General expenses will be debit and bank will be credit. This is very simple journal entry. Okay. In the fifth entry, what we have to do, cash drawings of $200 had been debited to cash account and credited to the drawings account. So now it is very simple. We have to debit the drawing account and we have to credit the cash account. Okay, and we will be debiting the drawing with the 400 and crediting the cash with 400 as well. Hmm. Now we have to make the suspense account. So first of all, Sarah is credit and suspense is debit. So we have to write it here. Suspense is debit. Okay, and we have this one. This is also suspense account. Suspense account is credit and purchase is debit. So we just find out the difference, 420 minus 63. So there is a difference on trial balance, which is on the credit side. Okay. Now let's see the C part. Complete the tables by identifying the type of errors that occurred in error 4 and 5. Okay. Uh, so if you see error 4 and 5, no entry had been made for general expenses 126 paid by the bank transfer. So this is error of omission where you haven't made any entry. So this is called or error of omission. Fifth one is that cash drawings of 200 had been debited to the cash account. It should be debited the drawing, but it should be mistakenly recorded in the cash account and carried to the drawings account. Means that drawing account should be debit, but we have credited it. So it means this is complete reversal. We basically reverse the entries with each other. So this is complete reversal. Okay. Now let's see that they are asking us have given us different number of errors, error 1, error 2, error 3, error 5, and 4. And we have to see that whether those errors decrease the profit or increase the profit, or maybe they haven't did any effect on the profit. So we have to see this. Let's see. Let's see the first error. So what happened in the first error? That a bank transfer 420 received from credit customer Sarah had been incorrectly recorded in the bank, but no other entry had been made. So this is related to the statement of financial position because customer, we will be writing the trade receivables in the statement of financial position, and we will also write the bank balance in current assets in statement of financial position. So it means that there is this will not affect the income statement. That's why there is no effect. Now let's see error 2. Netly contributed a personal vehicle to business value at 7,000. This had been debited to the capital account and credited to the vehicle maintenance account. So since we credited it with the vehicle maintenance account, it means that we have decreased the expense. Okay, we understate the expense. So when we understate the expense, so now what does it mean? How this will affect the profit? We have credited the better vehicle, personal vehicle, this is debit to the capital account and credited to the vehicle account. Yes. So vehicle maintenance account is the expense, and you have decreased the expense account. So what does it mean? It means that it will decrease your profit as well. Mm, let me think. Added to. Hmm. You have decreased expense. Okay. Yes, it will decrease the profit as well. So purchase of 270 had been correctly entered in the supplier's account, but had been debited as 207 in the purchase account. Okay. So basically what you have did, purchase of 270 had been, okay, after correcting each of the errors. Okay. So now what happened here? Purchase of 270 had been correctly entered in the supplier's account, but had been debited to as a 207. So it means that purchase should record as 270. Okay. But we would have recorded it as 207. It means that we have decreased the purchase account. And we know that purchase is the part of the cost of sale, and cost of sale is supposed to deduct from the revenue. And if the cost of sale will increase, so it means that the GP will decrease, and if the GP will decrease, it means that profit will also decrease. So now what happened here? We should debit the purchase account with 270, but we mistakenly recorded 207. So it means that we did make a mistake. It now it should we have to increase it with 63. So when we will increase the purchase with 63, so if purchase will increase with 63, so it means that cost of sale will also increase with 63. It means that GP will decrease with the 63, and your profit will also decrease with the 63. Okay. So it will decrease the profit. No entry had been made for general expenses 106 paid by the transfer. Okay. So you should make the inventory for general expenses. So if expenses are increasing, so profit will decrease. We know that. So you haven't recorded this entry. Now, when we will rectify this, when we will record this, so it means that your expenses will increase and your profit will decrease. So that's why it will decrease the profit. Expense 5, cash drawings of 200 had been debited to. Okay, so this is about cash and drawing. So drawing is also the part of statement of financial position, and cash is also the part of statement of financial position under the current assets. That's why there is no effect on the profit. Okay. We are going to make the profit and loss appropriation account for the partners. So first of all, what we have to do, we have to write a profit for the year. Okay. And after that, we have to add interest on drawings. Okay. And we have to deduct the interest on capital. Okay. And we have to deduct the salary as well, if there is salary. So whatever the answer we will get, that will be our residual profit. And after that, we will be recording the profit flow for the share for each partner. Okay. Now let's see what is the profit for the year. Okay. So Ali and Sayi are the partnership. In the partnership, financial year ends on 30 June. The partnership agreement includes the following items. So we have these all items. Okay. So we have this information. We actually don't have the profit figure now. Drawings for Ali and Said is written here, capital account, current account. Okay, profit for the year before interest on loan, which is 42,700. It means that we have to deduct the loan from him. Ali provided a loan to partnership, which is $10,000 at an interest of 5%. So it means that we have to find out the 5% of 10,000. So this is equal to 500. So we have to deduct the profit before interest is 42,700 minus 5. So this is equal to 42,200. Okay. Now let's see the interest on drawings. So drawings are these are drawings 11,000 and 16,000, and the interest on drawing is 5%. So if you just multiply 5, apply the 5% on 11,000 and apply the 5% on the 16,000. So you'll get the answer for drawings, which is 550. For Ali, and for Say this is 800. Okay. So Ali and Say. So this is 550 and this is 800. Okay, so this is equal to 1350, and now we have to add this with the profit. It is giving you the answer, which is 43,550. Okay, now let's see the interest on capital. So the capital investment is 60,000, 40,000, and interest on capital is 6%. So apply the 6% on 6,000 and 40,000 respectively. So you are getting the answer for Ali, which is 3,600, and for the Say, which is 2,400. And let's see the salary as well. Salary. Yes. So Sai is entitled to partnership salary, which is 10,050. Okay. Okay. So if you deduct interest on capital and salary from the total of interest on drawing and profit for the year, so you'll get the residual profit, which is equal to 27,500. Now you have to um, divide this 27,500 with, between the partner as per their ratio. So if you just maybe find out 27,500, what is the per? Okay, so this is 3 into 2. So 27,500 multiply 3 into 5. 27,500 multiply 2 into 5. So this is equal to 16,500 and this is equal to 11,000. And altogether this is 27,500. Okay. So we have done with the account. Now let's see the second thing. Now we have to prepare the capital and current account for SAI and for the year ended 30 June 2024 and bring down the balance on 1st July 2024. Okay, first of all, let's write the opening balance. Sorry. So in SAI account, the capital is 40,000. So there is nothing else. We just need to carry down the balance. We can now prepare the current account for sale. Okay. So what is the opening balance? This is 2023, July 1st. Let's see the opening balance of SAI. So opening balance of SAI is equal to 250 carat. Okay. So we have to write it here. And after that, we have to write interest on capital, salary and profit share on the credit side, the drawings and interest on drawings on the debit side. Okay. So this is 2024. Uh, 2024, June 30. Interest on capital. And this is equal to 2400. We already have calculated this. Salary was 10,050. And profit share. Profit share is equal to 11,000. Okay, on the debit side, the drawings, and this is equal to 16,000. And interest on drawings. This is equal to 800. So now what is the total on both sides? The credit side is a heavy side, which is equal to 23,700. Now deduct the debit side from it. 23,700 minus 16,000 minus 800. So this is equal to 6,900. Okay. So now let's see the next question. C part say two disadvantages of operating as a partnership. So first of all, you have to share the profits. This is first advantage, and decisions must be recognized by all partners. Now let's see the D part. Prepare a journal entry to record the payment of interest on loan provided by Ali. A narrative is not required. Okay. So, payment on interest. So now what will happen? Of course, interest on loan will be debit because this is the expense for the business, and bank will be carried. Okay, now we have to prepare the cash book. Okay, so first of all, Jenny runs a small trading business. Jenny received her bank statement, which showed a credit balance of 136. This is a credit balance. Okay. 29 Feb 2024. On the same date, her bank column in her cash book showed an overdrawn balance, which is 933. So this is basically credit balance. So we have to write it here. Okay. So when comparing her bank statement and cash book, she found that following items appeared on her bank statement and not her in the cash book. Okay. First thing is February 26, M stores, a credit customer had paid by the bank transfer, which is 1900. So we have to record this on the debit side, because this is cash inflow. Okay, and second thing is interest received. So we receive the interest. So again, this is a inflow. So here we have to write it here. Interest received, which is 358. Okay. And we, okay, so now let's see the second one. A check previously received from C stores had been dishonored. So dishonored check should be carried. Okay. And bank charges are 125. So we also need to record this on the credit side because this is a cash outflow. Uh, Direct debit for electricity had been taken. This is 290. So again, direct debit, it is deducted from the account. That's why we have to write it here. Okay. Mm. Okay, so following items appear in her cash report, not on her bank statement. Okay, so what is this? Check pay to B properties. Okay, so check pay to B properties. So what is 1025 then? It means that 1025, you have given the check to B properties, but it haven't appeared on the bank statement. So it means that this is unpresented checks. Okay. A payment by credit transfer to pay for rent and insurance. So this is credit transfer. So it means that this is again unpresented, but it means that it haven't recorded in the bank statement. It hasn't presented yet, but you have recorded this into the bank's cash book. This is also unpresented. Check received from a credit customer via traders was paid into the bank. So you have recorded this into the cash book. You have debited, but bank basically haven't recorded this because this is uncredited checks. Okay. Upon investigation, she discovered the following error. So a check made payable to D Sports $45 had been recorded in the bank column of her cash book. A check made payable to D Sports, which is $45, had been recorded in the bank column of her cash book. Okay. So check had been written from her personal account to pay for her gym membership. So it means that we have to increase the cash book. Correction of error. Okay, so this is 45. Now we need to total the amounts. So total is 3469. Mm, this is closing balance PD, and this is equal to 1166. Hmm. 1166. Now let's see the BRS. Prepare a bank reconciliation statement at 29/5/2024. Start with the balance from Jenny's bank statement. Okay. So now we have to prepare the BRS. So we can use maybe balance on the bank statement, and we can also use the amounts balance in the cash book. So let's start with the balance on bank statement. So balance on bank statement, this was, I guess, 13,067. Yes, 13,060. No, sorry, 1,367. Okay. This is the balance on the bank statement. And now we have to Mm, now we have to add the amounts which is not yet credited because um, sooner or later the bank has to add back the checks which is not yet credited. So that's why we have to add the amounts which is not yet credited. Okay. So there's only one check with the name of Y traders. As you can see, this is the uncredited check. This is the uncredited check on 28 Feb. This is 792. Now we have to deduct which amount which is not presented. First is check B properties. And the next one is there is a credit transfer. Check first of all, first unbilled check was uh check with paid to B properties, and next one is the payment by credit transfer to pay for rent insurance, which is 2300. Okay. So this is 1025, and credit transfer, rent and insurance is 2300. So this is equal to 23325, and now deduct this from the total of balance on bank statement and uncredited check. So it will give you the negative answer. So balance in cash book, this is equal to 1166. Okay. So this is it for VRS. Now let's see the other question. So there's two advantages of preparing a bank reconciliation statement. So there's very simple. So first advantage is that an accurate bank balance is available. And the second thing is that errors on the bank statement can be identified. D part is explain why a bank overdraft is shown as a debit balance on a bank statement. So since this is an asset to the bank, so it is money owed to the bank. Now let's see this question. Jenny is concerned about her bank overdraft and considering adding additional capital into the business from her personal funds. Advise Jenny whether she should contribute additional capital to pay off her bank overdraft. Justify your answer. Okay. So advise on contributing the additional capital. Okay. First of all, first advantage is consideration for contributing additional capital. There is improvement of cash flow and financial stability. So by contributing additional personal capital, Jenny can directly reduce the bank overdraft, and this will immediately improve the company's liquidity position. So reducing reliance on expensive short-term borrowing and minimizing the interest burden on the overdraft. So this can lead to improved cash flow and financial stability. Giving the business a better chance to weather any temporary cash shortage, it also sends a positive signal to creditors and potential investors about Jenny's commitment to the business. Second one is ownership and control. So adding personal funds to the business would increase Jenny's equity stake in the company, which can be beneficial in terms of retaining control over decision making and ownership. However, it is important to consider whether the added financial burden could lead to personal financial strain or impact her ability to cover the personal expenses. So if the business fails to improve, so Jenny may face both business and personal financial difficulties. Now let's see the potential disadvantages. So first disadvantage is personal financial risk. So contributing additional capital to the business exposes Jenny to higher personal financial risk. So if the business does not improve or continues to face financial difficulties, so she may lose the funds and she injected this could place her personal assets at risk. So particularly if the business faces insolvency. So in this scenario, Jenny might find herself with the reduced personal saving and no assurance of repayment from the business. And the second disadvantage is that there is short-term solution, long-term challenges. So while adding capital may solve the immediate issues of bank overdraft, so it might not address the underlying reason for business financial difficulties. So if the business is not generating sufficient cash flows or has ongoing operational inefficiencies, so Janice's contribution may be a short-term solution rather than a long-term fix. So to avoid recurring financial struggle, it is crucial to identify and address the root cause of the overdraft, such as poor cash flow management, low sales, and high expenses. Now let's see the conclusion. So while contributing the additional capital can help resolve the overdraft situation in the short term, it exposes Jenny to personal financial risk and may not address the root cause of the business financial issue. So if Jenny is confident that a business has a potential to recover and become profitable, so this could be a good move. However, she should also consider exploring other options such as improving cash flow management, reducing cost, or securing a loan with more favorable terms. So before risking her personal savings, additionally, Jenny may want to seek professional advice to evaluate whether the business current financial difficulties are a temporary setback or indicative of a more significant problem. Okay, so this is it for today. We have completed the 5 questions, and let's meet in the next video with the A levels paper 2 variant 2.